Welcome back, class. This is a video for Chapter 8, analyzing plant assets, long-term assets. We're looking at here specific kinds of assets that are going to last multiple years. So when we look at that, we're going to figure out, okay, what are we looking at? How do we determine the cost? The cost is going to be the cost of acquiring the asset. It may include other costs that are necessary in order to get it ready to use or prepare it for what we intend. So, for example, if we purchase machinery and equipment, we may require freight to get it to us. We may require installation or special equipment to set it up. And if we do, then that will be a part of the cost of the equipment that we purchased. If we buy a building, if we have a building is going to be a structure on the land. And if we're going to go buy a building, we're going to include costs like realtor fees, taxes, title fees, attorney's fees, any expenses to get that building ready for its intended use. And again, we'll come back to that in a minute, but those are the costs that we're going to include in the building account. Land improvements are going to be walkways, parking lots, landscaping. You can landscape and basically call that land improvements, and you're going to depreciate all of those for a period of time. Believe it or not, trees and bushes do have a useful life, and I've seen them listed in the AHA, American Hospital Association, depreciation guide or asset life guide. But anyway, you do depreciate those for a period of time. And then land, by the way, land will not depreciate. It's an item that we're never going to depreciate. Now, it could become impaired for some reason or another, but it's not going to be depreciated. So we need to know when we buy a building that we're buying the building and the land that it sets on. So with that in mind, we need to be able to allocate the cost between the land and the building. And we show that calculation here. In this calculation, you see the building cost of $60,000, the land cost of $40,000, and a total, well, this isn't cost, this is appraised value, the total appraised value of $100,000. So 60% of the building's appraised value goes to the building, 40% goes to the land. You're paying $90,000 for the building, so 60% of that's in the building, 40% in the land. You see the calculation there. Depreciation, and by the way, this apportionment will be used to establish the value or the book value on those assets when you acquire them. Depreciation is the cost of allocating an asset over its useful life. In order to do this calculation, you need to know what the useful life is, what the salvage value is, and what the cost of the asset is. So the cost is going to be the cost of getting the asset to your facility and installed and ready to use. The salvage value is what you can get out of it if you scrapped it out at a scrap yard. This is not a value for the way it functions. This is a value for what's contained in it. So if you took a machine out to the scrap yard and they gave you so much for the scrap metal in it, that's a salvage value. The useful life is whatever is estimated to be the length of time that the asset will last. In many cases, this is going to be based on some kind of information that you may have. There are, like I said, the American Hospital Association published a set of useful life guides for hospitals. There are similar things for other industries, I'm certain, because the equipment, for example, in a hospital, the equipment is unique into those settings. So like an MRI machine or a CAT scan machine, a diagnostic imaging piece of equipment would be valued and depreciated in a unique kind of way. So those things are helpful. So you basically, when you say useful life, this is an economic useful life. This is how long I can derive economic benefit from the asset. This is not about how long will it last. This is about how long will I get economic benefit out of it. I may lose economic benefit because the asset becomes inadequate, that it's not able to do what I need it to do. or it may become obsolete, that there's some other development that it doesn't have that I need in newer equipment. So the obsolescence, it may be, okay, well, it no longer performs the function that I want or need. So when we look at depreciation methods, we can look at a couple of different approaches. One of them is a straight line method, and we're going to take the cost minus the salvage value divided by the useful life. That'll give us a straight amount of depreciation each year. And as we depreciate the asset, we'll see a very even depreciation expense across all years. There'll be a declining balance sheet value, but a very steady cost for a depreciation expense. Another way of thinking about straight line is looking at the rate of depreciation that we have. So on a 5-year life, we would take 100% divided by 5 years and get a 20% straight line depreciation rate. This rate is going to be important to us when we get to our third method of actually calculating depreciation. And we'll talk about that then, but basically this is going to produce the same result as we did up above when we divided by 5 years. Units of production method is going to estimate how much a piece of equipment will produce, and based on that equipment producing that amount, you'll take the cost minus salvage divided by that production level to get a unit cost or unit depreciation based on per unit cost. So in this case, you have 10,000 minus 1,000 divided by 36,000 shoes. So when we're looking at this machine is going to make 36,000 shoes, so we depreciate 25 cents per shoe. And it would be calculated the way it is in this table in Exhibit 810. You see the units are changing every year, and you'll see the same depreciation per unit used, and you'll see the calculation here. Now, just as a word, now it is possible that partway through this useful life there will be some change in the estimate for its life or how many units it will produce, and it is possible for that to change. There would be a change in the calculation. But typically you're going to see something that looks like this, a very predictable and fairly even calculation of depreciation expense based on the production each year. The last one is a declining method, a declining balance method, double declining balance. And we call it double declining balance because we take double the straight line rate. So the straight line rate here is 100% divided by 5. It's 20% per year. We double it. In other words, we take 2 times that rate. 2 times 20%, that's 40%. That calculates our depreciation each year. Couple of things that are important to remember with a double declining balance. You do not subtract out salvage value when you start using this. You just use the asset cost. And so here, for example, $10,000, we're not taking out the salvage. We're going to consider the salvage value, but we're not taking it out. Times the 40%, we get $4,000 depreciation with a remaining book value of 6. Next year we move here, we got 6 times 40%, we get 2,400. A total depreciation of 6,400, and then we're going to have a book value of 36. We keep doing this. Now I want to point out the last year. We get down to the last year and we have a book value of 1,296. And we still show the rate at 40%, but we are not calculating this at 40%. This is 296, and if we were calculating 40%, we'd be much higher than that. The reason this is only 296 is that we are going to make sure that this depreciation in this year brings us down to the salvage value. So in the last year of the asset, we're going to basically calculate what we need here to get this number to be here. So in this case, 1296 minus 296 will give us $1,000, which is the salvage value, the residual value of that asset. Now, if you look at these different methods, you can see how the costs compare. Honestly, in the work that I did not see very many people use anything but straight line, which is consistent with what this survey says. My experience is very similar to this, and I think it was because straight line was so easy to apply. It was very predictable, very easy to use. I did see some folks use an accelerated method, but not many. The largest number of people that are businesses or hospitals that I looked at used a straight line method of depreciating their assets. Now, if you go to the IRS and you file your tax return, you will not be able to use the depreciation methods that we've just highlighted. So when you look at these depreciation methods, straight line, units of production, double declining balance, the IRS does not allow that. They have their own system called the Modified Accelerated Cost Recovery System. And based on the asset class and the number of the asset class, you will be assigned a number of years and a percentage that you can apply to that asset to calculate that expense. Now, this is not allowable for accounting purposes, but it is a requirement for tax purposes. So you may use straight line on your books, but for your tax return, you'll use the modified or MACRS. That's what they call it. So if you purchase an asset partway through the year, you need to consider that. In this example, the individual business purchased an asset on October 8th. And what they do is they say, well, if it's close to the first part of the month, we're going to basically use the entire month for that asset. So we're going to count the whole month of October as a purchase month, November and December. So we have 3 months that we actually use this asset. So they purchased the asset and put it into place on October the 8th. So you're going to go back and calculate how many months that is that it was in use for the first year. And in this case, we're going to calculate the depreciation on a straight line method like we normally would, but we're going to factor it by 3 months out of 12 to get a prorated depreciation amount in that first year. The same would be true if we sold it before it was fully depreciated. In this case, they're selling it before it's fully depreciated, so they take the cost minus salvage to get the book value and divide by 5, but they multiply that times 5 divided by 12, and it's 5 because they sold it on May 24th. So we're going to count the entire month of May, April, March, February, and January. All of those are going to be here. So we have 5 months that we're going to count out of 12, and that'll be prorated here. Now, it is possible for an estimate to change. For example, if you're using an asset and partway through the period of using it, you see, okay, this is going to actually last longer than I thought, and maybe the salvage value won't be as much as I thought. So in the case where you have a reduced salvage value, you're going to show that here. You'll have a reduction from 1,000 to 400, but you're also going to add useful life onto it. So at the beginning of the third year, the book value is 6,400. And with that, you want to adjust this salvage value. So you take 6,400 minus 400, gives you 6,000 divided by whatever time is left. In this case, 4 years. And you're going to get $1,500 per year. And that, by the way, will be shown on a present time going forward. You don't ever go back and restate an estimate. You basically move forward. You don't go back and restate that. So that's the calculation for your information. All right. Now, it is possible that you'll have some additional expenditures for assets. These will be either in the revenue side or on the capital side. If they're revenue, they're going to the income statement. If they're capital, they're going to the balance sheet. Ordinary repairs, where you put a piece on a machine in order for it to continue working at its normal um, way, and you basically put a repair into it so that it works the way it originally did. You're actually using just a maintenance and repair expense. You're not improving the machine. You're basically restoring it to its previous capacity by changing a part. For example, if you had a machine and the belt broke, you go out and change the belt. That's a repair expense. In my experience, probably the largest repair expense I've ever seen was on a CAT scan machine, where they had a CAT scan tube go out and they had to replace it, and the CAT scan tube was $100,000. But that was a repair expense because it did not improve the machine. It just basically made it work the way it was intended. So those kinds of expenses are on the income statement, and they go into a repair expense account, and they show that journal entry here. Now, if you actually improve the equipment, a betterment or an extraordinary repair would be a capital expense. That is, you would revalue the asset on the balance sheet, and you would use that to calculate a new depreciation. So, in other words, if you came along and you had a piece of equipment you wanted to completely rebuild so that you'd be able to use it later, you would have an extraordinary repair or a refurbishing of that piece of equipment, and that would then extend the useful life or increase the value. So you would revalue that and depreciate it, starting with that again. So betterment improvements are added to the cost of the asset, and then you would recalculate the depreciation at that time. When you get rid of a piece of equipment, a piece of equipment or any kind of an asset, if you have it fully depreciated and all you do is scrap it out, there's no gain or loss. You just basically write off the equipment here, the credit for the equipment, write off the accumulated depreciation, and you're done. There's no expense related to that. However, if your actual value of the asset is less than if you haven't fully depreciated, in other words, if accumulated depreciation is not equal to the value of the asset, you're going to have a loss if you dispose of it in the same way. So here, for example, they have an asset worth $8,000. They're going to dispose of it. They're not going to sell it. They're just going to get rid of it. You credit the asset for $8,000. You debit the accumulated depreciation for $6,500, and the difference will be a loss on the disposal of the equipment. It is possible to sell a piece of equipment and to have a gain or a loss. If cash is involved, there can be, and typically is, either a gain or loss. So when you're looking at this, they're showing a calculation for part of the year to record depreciation expense here, but then they're going to sell this asset, and it's going to be sold for exactly what you have in the book value. The book value, again, is the asset minus accumulated depreciation. So in this asset, they sell it. They sell it for exactly $3,000, which is the book value. There's no gain or loss. You basically debit cash, you credit the asset, and you debit the accumulated depreciation amount. Well, if you sell it for more than the book value, you're going to have a gain. Now, this journal entry is incorrect here. It should show, they say here in this example, they received $7,000, which is $4,000 above the book value. So here you would have cash of $7,000, accumulated depreciation of $13,000, and then you would have equipment of $16,000 of the credit, and then you'd have a gain on sale of equipment of $4,000. That would be the correct journal entry. If you sell it below the book value, you're going to have a loss. So the loss would look like this. You receive the cash, which is less than book value. We have a loss on disposal of $500, which is a debit. We'll debit the accumulated depreciation, and then we'll credit the equipment. Again, that's just removing the equipment accumulated depreciation, but you have a loss because you sold it for less than the book value, the current book value that you have on the books for it. Okay, when we talk about natural resources, this is going to be like mineral ore or timber or coal or oil or something of that nature. We're not going to call it depreciation, we're going to call it depletion. But depletion works exactly the way the units of production approach works. When you buy the land or the rights to the ore or the timber or the oil, there's going to be an estimated number of tons that you're going to be able to get out of that. So you're going to say, all right, I'm selling this or I'm purchasing this for $500,000. I estimate that I'm going to get 250,000 tons out. So I calculate the cost minus salvage value divided by the total units I expect, and I'll have $2 a unit. That is a depletion rate per unit. So we're going to, for every ton we take out of the ground, we're going to multiply it by $2 to get the depletion amount. So depletion expense for the first year would be recorded like this. We calculate $2 times 85,000 tons to get $170,000 in cost. So depletion expense would be $170,000. Accumulated depreciation would be $170,000. If we had showed on the balance sheet like this, we'd have an account for mineral deposits minus accumulated depletion, and we would have a book value for those deposits. Now, because if we have, for example, that all of the tons are sold during the entire year, we would have all of that expense showing on the income statement. But if some of it remained behind it, as it wasn't sold all in the first year, we would need to identify some of that as being in an inventory account. So what they do here is they show you that because only 70,000 tons were sold, they're going to only put in depletion expense the 70,000 tons times 2, 140,000. The difference between the accumulated depreciation that's there and this number will be ore inventory, because we're going to keep that in inventory and then sell it as we go. And many times there will be plant assets that are related to the depletion of these units. And basically they're going to be depreciated like we would normally depreciate any piece of equipment. Finally, the last part of this chapter is dealing with intangible assets. And when we're talking about intangibles, we're talking about patents, we're talking about copyrights, trademarks, and so on. A patent would be something you would get from the federal government to identify your invention as exclusive, and your product or whatever you've created would be exclusively used by you for a period of time. Typically, a patent will be amortized, and we say amortized because we're going to have a cost associated with the patent, but we'll spread it out over 20 years. If we buy a patent, and that does happen sometimes, we buy a patent that costs $25,000 and useful life of 10 years, we would show the amortization expense for that at the end of each year. So here we're going to amortize the expense at the end of the first year of $2,500, because we take the $25,000 divided by 10 years and we show that there. That's going to be a debit of amortization expense, a credit to accumulated amortization. It's not called depreciation, but it works just like it, except we're going to be writing off this cost of this intangible asset over a period of time. We have franchises and licenses, trademarks and trade names. Many times you are charged if you are starting a business and you're going to do a franchise. I know McDonald's used to charge quite a bit for their franchises, but whatever that cost is then amortized over a certain period of time. Trademarks are the same way. There are many trademarks that are used, but those are also intangible assets. Goodwill is an intangible asset, but it only occurs when you buy another business. when a company purchases another business or segment of business, and it pays more than the book value of those assets for it, the difference is called goodwill. And the idea of goodwill is that you're purchasing, you're paying extra for this business because there's a certain amount of public notoriety that's good with this business that's intangible, that doesn't necessarily reflect on the books. So there may be a reputation that's very positive, and you're willing to pay a little extra for that. So when you're talking about goodwill, that only occurs when you purchase a segment of a business or an entire business. And then the right of use asset, which is a lease. It's basically a lease or a leasehold. These are rights that you're granted under the terms of a lease. So you may lease a building, and then you have leasehold improvements. Under the leasehold, you may actually customize the building. And again, for example, if you were a store, like if you didn't build your own, if you were a store like Meijer and you moved into a store building, a large building that did not have a lot of the structure that you needed in order to carry on business, you would put in equipment in the store that would very likely be considered leasehold improvements, and those would be depreciated just like anything else. By the way, the leasehold improvements are depreciated for the life of the lease, however long that is. Research and development costs are expenditures basically aimed at creating new products. And these are the costs associated with creating patents, copyrights, and other products and services. They are expensed when they're incurred. They are not amortized. So research and development is not amortized. It's expensed. Okay, so any other intangible assets? There may be some like software, non-competition agreements, customer lists, and so on. But again, that's going to be very similar to the other intangibles. If you know what value it has and how long it should last, you're going to basically amortize that over the length of time that you will use it. So that really covers everything I want to cover in Chapter 8 right now. And this video will be 8. Chapter 9 video will be coming.